Financial crashes have been a part of America's history. We promise by the end of this video, you'll have a deeper understanding of major economic recessions than your high school history class ever offered. So, keep watching until the end. Hi there, this is Simply Economics. I need your help. For us to produce more amazing content, we need your support by subscribing to our channel. Hit that notification bell too. What is a recession? Recessions are economic downturns characterized by consecutive quarters of decline in real GDP. In the U.S., a recession is a significant and prolonged downturn that affects multiple sectors. The National Bureau of Economic Research uses indicators like GDP, employment, income, production, and sales to define recession periods. Since the Great Depression, the U.S. has experienced 14 recessions, which, although significant, have had relatively short durations in economic history. The Great Depression, 1929 to 1933. In the 1920s, America recovered from the disruptions of World War I. The U.S. economy thrived as Americans embraced the New York Stock Exchange. During the Roaring '20s, investors used high levels of margin. However, escalating spending led to overvalued assets. On October 29, 1929, the stock market crashed, triggering the biggest recession in U.S. history. The Roosevelt Recession, May 1937 to June 1938. The Roosevelt Recession, a severe recession in the 20th century, was overshadowed by the Great Depression. Real GDP and industrial production plummeted due to the New Deal's fiscal and monetary policies. The U.S. economy fully recovered from the Great Depression in 1939, following this recession. The Union Recession, February to October 1945. After World War II, the U.S. experienced the Union Recession. It was caused by reduced government spending, demobilization, and work stoppages. Despite a decline in production, the recession was not as severe as expected, possibly influenced by past economic downturns. The Post-War Recession, November 1948 to October 1949. The post-war recession lasted only 8 months, showing the successful adaptation of the U.S. to post-World War conditions. This was followed by a strong 45-month expansion period with an impressive annual GDP growth rate of 6.9%. The Post-Korean War Recession, July 1953 to May 1954. The U.S. experienced a post-Korean War recession due to high war-related expenses, leading to inflationary pressures. To combat inflation, the Federal Reserve tightened money supply and borrowing costs. This lasted only 10 months but had a significant impact. The Eisenhower Recession, August 1957 to April 1958. The 1957 Asian flu had a global economic impact, leading to labor shortages and production slowdowns. To address this, the Federal Reserve raised interest rates, impacting housing and auto sales. The Rolling Adjustment Recession, April 1960 to February 1961. The Rolling Adjustment Recession in the automotive industry caused a decline in domestic auto sales and production. However, the economy rebounded with a remarkable 9-year expansion from 1961 to 1969, doubling cumulative GDP and achieving over 90% growth. The Nixon Recession, December 1969 to November 1970. The Nixon Recession, lasting 11 months, followed a period of economic expansion. Eliminating the gold standard in 1971 led to floating currencies and increased central bank control. This decision also caused recession and inflation as the dollar's value declined. The Oil Shock Recession, November 1973 to March 1975. After a brief recession, the economy saw solid growth, only to be abruptly halted by the 1973 oil crisis. This led to a period of stagflation, high inflation, and stagnant growth. The quadrupling of oil prices by OPEC and the 1973 stock market crash contributed to a recession marked by stagflation. The Energy Crisis 1 and 2 Recession. After Oil Shock Recession, the economy experienced a period of growth. However, high inflation and soaring energy prices posed challenges. The economy faced a double-dip recession in 1980, followed by the worst economic downturn since the Great Depression from 1981 to 1982. Unemployment rose and GDP fell during this period. The Gulf War Recession, July 1990 to March 1991. The 1990s Gulf War Recession, caused by the conflict's impact on oil prices and the savings and loan crisis, led to a temporary economic downturn. Iraq's invasion of Kuwait disrupted oil production, causing price increases. The Dot Com Recession, March to November 2001. The 1990s com recession was triggered by the crash of internet company stocks and higher interest rates. It lasted 8 months, resulting in a 5.5% unemployment rate and a 0.95% decline in GDP. This pessimism was further fueled by the September 11, 2001 attack on the World Trade Center, the Great Recession of 2008, December 2007 to June 2009. The Great Recession was a global financial crisis caused by the subprime mortgage crisis and the collapse of the U.S. housing bubble. It led to a deep recession, with stock markets crashing, unemployment soaring, and major financial institutions failing. Recovery efforts involved interest rate cuts, stimulus packages, and the enactment of the Dodd-Frank Act. The COVID-19 Recession, February to April 2020. The recession greatly impacted the U.S. economy, causing a sharp decline in GDP and widespread job loss. However, the government implemented measures such as zero interest rates, stimulus packages, and small business loans. Remarkably, there was a strong recovery, with real GDP growing by 5.6% in 2021 and historic lows in unemployment. While recessions are painful, it is important to acknowledge the potential for a powerful recovery that follows. Thanks for watching, guys. If you enjoyed this video, please make sure to give it a thumbs up and hit that subscribe button so you don't miss out on any of our future content. We truly appreciate your support. See you in the next one.